In today's video, we're going to delve into a crucial topic that, honestly, every potential homeowner, investor, and real estate enthusiast should understand. What always happens before a real estate crash. The real estate market, as you probably know, is famous for its cyclical nature, and being able to recognize the signs that come before a downturn can be the key to making truly informed decisions. As we explore this topic, we'll highlight the common indicators that often signal an impending crash. From rising interest rates and increasing inventory levels to declining home sales and, affordability issues, these signs can really provide valuable insights into the health of the market. Additionally, we'll discuss how economic factors like job growth and consumer confidence play a significant role in shaping real estate trends. By understanding these indicators, you'll gain a clearer perspective on the dynamics of the real estate market and honestly, the importance of timing when it comes to buying or selling properties. Our goal is to engage you with informative content that not only educates but also empowers you to navigate the complexities of real estate with confidence. So, whether you're a seasoned investor or a first-time buyer, stay tuned as we uncover the patterns that often come before a real estate crash and how you can prepare for them. Declining affordability is a critical factor that, really affects buyer demand in the real estate market. Housing affordability is usually measured using metrics like the price-to-income ratio, which compares median home prices to median household incomes, and the mortgage payment-to-income ratio, which looks at how much of a household's income goes toward monthly mortgage payments. When these ratios rise, it means homes are becoming less affordable for the average buyer. One of the main drivers behind declining affordability is the phenomenon of rising home prices outpacing wage growth. As property values increase, a lot of potential buyers find themselves priced out of the market and unable to secure financing for homes that have just gotten too expensive. This disconnect between wages and housing costs creates a tough environment for first-time buyers and those with lower incomes, which in turn leads to a decrease in overall buyer interest. The consequences of decreased buyer interest can be pretty profound. As demand drops off, sellers might have to lower their asking prices, which can slow down the market. This slowdown can create a ripple effect, impacting property values and potentially even leading to a broader economic downturn. Plus, decreased buyer interest often results in longer listing times for homes, increasing the likelihood of market stagnation. Understanding the implications of declining affordability is essential for anyone navigating the real estate landscape. Investor sentiment refers to the overall attitude and feelings that investors have toward the real estate market, and this can really influence buying and selling behaviors. This sentiment is pretty crucial in real estate since it often dictates market trends and can even serve as an early warning system for potential crashes. When investor confidence is high, demand usually goes up, and that drives prices higher. But when sentiment shifts, it can lead to decreased demand and falling property values. Indicators of shifting investor sentiment often include increased caution among buyers and sellers, as well as a rise in market volatility. For example, when investors start expressing concerns about economic conditions, interest rates, or maybe even overvaluation, they might take a more conservative approach, delaying purchases or selling off properties. This cautious behavior can show up as declining transaction volumes and longer listing times for properties. Historical examples really show how negative sentiment can trigger market reactions. During the 2008 financial crisis, there was a big shift in investor sentiment as fears of a housing bubble burst spread. That led to a rapid decline in home sales and a sharp drop in property values. Similarly, in the early 1990s, a downturn in investor confidence resulted in a market slowdown, with a lot of investors pulling back from purchasing properties. Understanding these dynamics is essential for recognizing potential signs of an impending market crash. When analyzing the potential for a real estate crash, there are several key economic indicators that play a really important role in forecasting market performance. Among these, unemployment rates and GDP growth are two of the most significant. High unemployment rates often signal economic distress, leading to decreased consumer confidence and reduced purchasing power. When people are uncertain about their job security, they're just less likely to invest in real estate, and that results in diminished demand. GDP growth, on the other hand, reflects the overall health of the economy. A declining GDP can indicate a recession, which usually correlates with a slowdown in the real estate market. As economic activity contracts, fewer people are able to afford homes, and property values can start to go down. Historically, economic downturns have had some pretty profound effects on real estate markets. For example, during the Great Recession of 2008, a combination of rising unemployment and negative GDP growth led to a significant crash in the housing market. Home prices plummeted, and a lot of homeowners found themselves underwater on their mortgages. Similarly, in the early 1990s, a recession triggered by rising interest rates and a slowdown in economic growth resulted in a sharp decline in real estate values. Understanding these economic indicators is essential for anticipating potential market shifts and making informed investment decisions. In this video, we explored the critical signs that can indicate an impending real estate crash. We talked about how rising interest rates can impact mortgage affordability, which leads to decreased buyer demand. We also looked at the effects of overbuilding and supply surplus, which can create an excess of properties that drive down values. On top of that, we highlighted the importance of understanding declining affordability and how it affects potential buyers, as well as the role of shifting investor sentiment in shaping market dynamics. Lastly, we reviewed key economic indicators like unemployment rates and GDP growth that can serve as warning signs for real estate performance. Staying informed about these market trends is really essential for anyone involved in real estate, whether you're a buyer, seller, or investor. By recognizing these indicators, you can make more informed decisions and better navigate the complexities of the market. If you found this information valuable, we encourage you to subscribe to our channel for more insights on real estate trends and strategies. Don't forget to like this video and share it with others who might benefit from understanding the signs of a potential market downturn. Your engagement helps us continue to provide valuable content and keep you informed about the ever-changing landscape of real estate. Thank you for watching.